In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcasts, type in Old Dogs, spelled D-A-W-G-S, find our podcast and subscribe. Well, we got a great show for you today. We got a gentleman here that is based out of Texas. And if you listen to the show, that we talk a lot about Texas. There's a lot of great stuff happening there, and real estate is one of them. Now, granted, it may be getting very competitive in some areas, but I hear there's deals being found all over the place. So, but he'll be able to tell us a little bit better. I'm talking about Sam Bates, and he's the founder and CEO of Bates Capital Group and co-founder and managing partner of Trinity Capital Group. Sam started his real estate journey in 2009 and has been directly involved in the acquisition, reposition, disposition, and asset management of over $100 million in real estate. His portfolio currently has 749 units in Texas, Mississippi, and Georgia. Sam and his partners have roughly another 250 units in the pipeline to be developed. I'd like to hear what that's all about. And Sam has a Bachelor of Business Administration degree from Texas A&M in finance and an MS in personal financial planning and an MBA from Texas Tech University. Well, that's a guy definitely has got his financial thing together here. Well, Sam, welcome to the Old Dogs REI Network.
Well, Bill, thank you for having me. I'm excited to be on your show and hopefully share value to your listeners and help them just get a better understanding of maybe the multifamily market in Texas or the multifamily market in general. Awesome.
Well, I'm sure, our audience likes to know who's talking here, and instead of just jumping into topics, I would love to hear your story and where you came from, how you ended up not only in Texas but in the multifamily world.
Yeah, definitely. I grew up in a small town, actually in a farming community outside of Lubbock. My dad was a farmer, and both my parents were actually teachers. They didn't have anything to do with real estate, and I didn't really have a understanding for real estate growing up, but I always gravitated to the stock market. And luckily, one of my grandparents, they talked and showed me his portfolio. And just as I was young, he always discussed his portfolio. And by the time I was like 11 or 12, I actually started investing in some mutual funds. And I knew I always wanted to do something with investments. And then I went to A&M and got my undergrad in finance. And I thought I was going to, after graduation, I was going to go and get my master's in real estate. But in between undergrad and grad school, I started working at UBS Financial out in Los Angeles. I had an internship, and they gave me a full-time offer. And at that time, I loved what I was doing. So I worked out there for about 2 years as an investment analyst, putting together high net worth individuals' portfolios. At that time, the stock market was going up pretty much without doing anything wrong. It just kept going up in that 05, 06 timeframe. So my job got kind of monotonous, and I wanted to go back to grad school. And at that time, since I was in the equities market, I thought it'd be a good transition just to get my master's in personal financial planning. And I went to a school that had a joint MBA program, and they also had the ability to, if I wanted to sit for my CFP with the classes that I took, I could. Well, long story short, the market crashed when I was in grad school, and I didn't want to go out to clients and high net worth individuals and try to convince them to give me money for a asset or investment that I had absolutely no control over. And when I saw my grandpa's portfolio, some of the clients I worked with, my personal portfolio in '08 dropped 30, 40, 50%. I just couldn't go to people that had worked their entire lives, 30, 40 years, to see their savings get reduced in a couple months. So I actually worked at a consulting firm after grad school. And that I thought I was going to be in one division of the consulting firm, and they actually put me in another division that handled sales and use tax. And honestly, I didn't know even what sales and use tax was until I got to the company. But luckily, that was the catalyst to get me back into looking at real estate. And that's kind of where it started my real estate journey as a limited partner, then moving to the general partner side.
Oh, interesting. So you started as an investor on the real estate side. I mean, were you working full time and then started investing in syndications or?
Yes, I was working full time, and I invested in 3 syndications actually. 2 were apartment syndications, and 1 was a hotel syndication. One of the syndications never got off the ground. We went through DD, and the operator at that time saw some things that he didn't like with the due diligence, so he backed out. But he kept roughly 13% of the amount I invested, which I would never do to a limited partner. But that kind of rubbed me the wrong way. And then we had the hotel syndication. It actually ended up in litigation because it was a development that never got off the ground. And then I was in the 3rd syndication. We went full cycle and exited, and that was a 208 unit in Dallas, and 208 unit property in Dallas. And it did well overall, but there were some issues with it. We had to remove the GP and bring in other people to run the GP. So with all 3 of those syndications, there were just a lot of issues that nobody expected. And that was part of the reason that I decided investing in single family on my own. And then when I had enough capital built up, I started looking at multifamily, and I invested, I guess, from 2010 to 14 in single family. And then 2014, I made the switch to multifamily and started looking at apartments, acquisitions, and developments at that point.
And with the single family, how many homes did you acquire during that time?
Roughly 20. I think there was 18. And I did buy and hold, fix and flip. I did a single family development or spec build. So it was kind of anything and everything in between. And they were great investments. I learned a lot. A lot of it wasn't preferable to multifamily, but it was a good way to start my investing career and build a little nest egg as I grew in my career. But I realized it wasn't scalable. And especially in Texas, we have foundation issues. Over the last 10 to 15 years, we've experienced a lot of weather issues. And if you have a large CapEx item to one of your single family homes, that can kill your cash flow for two or 3 years. So it's also I realized from a risk mitigation standpoint, it was better to scale and go into multifamily where you have a lot more doors to protect your assets if something were to happen.
So did you start to sell off those single family homes?
I I've sold off most of them. I still have 8 of them, and I'm going to dispose of a few more this year. And then the remaining ones are in really great locations in DFW, and I think they're just going to continue to appreciate over the next 30, 40 years. So I plan on holding on to those for a long time.
Now, did you start buying smaller, maybe multis like fourplexes and so forth, or did you just jump into larger apartments?
Well, it was kind of a progression. I initially thought I was going to be buying just a small apartment for myself, and then I ran into a old coworker of mine who was doing the same thing, and he was looking for a small apartment, and we decided to partner up, and we started looking back in 14. And at that time, everybody was saying the market was going to correct in 16 or 17. So we were underwriting really conservatively. And also, my partner was younger than I am. And at that time, I was in my late 20s. And we had a couple brokers that actually told us that we offered the best price on deals, but the seller didn't go with us because they didn't believe we could close because we didn't have any type of track record. So after about a year and a half of going through that and not getting any deals, we brought in a third partner who had 20 to 30 years of construction experience. And the first project we did was actually a mixed use development. It was a 60 unit apartment complex with 10,000 square feet of retail space.
Wow. Wow. So that was a pretty big jump. Was that your first syndication too?
Yes, it was my first syndication as a general partner, and it was a big jump, but we felt confident that we could raise the money, and we felt really confident about the project. It was just having to line up all our ducks in a row and make sure everything was executed as well as it could be. And I actually went back through some of the documents and underwriting about a year ago. And this was back in the initial underwriting we did was probably into 15 or first to 16. And it was just interesting to see how much I've grown from 2015 to 2021.
Just looking at how you worked the numbers back then?
Yeah, just how the numbers worked, just some of our expectations on how the deal would go. And of course, with ground up development, it's never going to go smoothly. And there's always some hurdles or roadblocks that you have to work through, whether it be with construction, planning and zoning, the landowners. There's just always something that you're never going to be able to 100% plan out. And you try to mitigate that risk as best as possible, but it just doesn't always happen.
Yeah, definitely. Well, there's a couple of interesting things here you said that I'd like to you may zoom in on a little bit. Is that as you were moving from an individual investor to the point where you realized there'd be an advantage to having a partner, and it was somebody you knew, and obviously felt comfortable partnering with. But that's a big decision. I've talked to a lot of people over the years, and one of the biggest challenges sometimes are partnerships. And but you found somebody you felt comfortable working with. And then you went another step and realized that there were certain things the two of you were lacking. And so you find, another person that kind of fills that gap. And yeah, maybe you could just kind of get a little bit more in depth into that thought process and how did you find these people?
Yeah, I've luckily been able to build my business in multifamily with some great partners, and partnerships are like any relationship or marriage that there's, you need to surround yourself with somebody that you trust, that you know thoroughly and completely, because there are going to be times where you might not agree 100% or you completely disagree. and you're going to have to work through those. And I think it's important to have the same beliefs and the same work ethic, and many of your goals and values need to align. I think if you're partnering with somebody that you don't have the same goals and values, that's going to be very difficult to have a successful partnership. But the two guys I partnered with initially, one I'd worked with on a daily basis for over a year, and I saw his work ethic. I knew him and his wife. I knew a lot of what I just knew what type of person he was. So it was pretty easy to think we would work well together. And we didn't, even though we knew each other, we didn't jump into it lightly. We still had many conversations on what we thought business would look like, how it should run, and got into the nuts and bolts of, if we were to partner, how we would run the apartment, how we would treat our investors, how we could steward the money that the investors give us the best. And all those aligned. And then we brought in the developer, the builder, and he also had a very similar background in terms of just his values, maybe not background, but his values and morals. And he had been in business for 20 plus years, and he had multiple successful companies. So he had a track record that we could look at to see how he had performed with his other companies. And one of the benefits we had is the first guy I thought about partnering with, he had actually invested as a limited partner with this guy before. So he got to see how he operated. He saw that the investment he invested in was a very successful investment. So over, I don't know, probably 3 or 4 months, we had multiple conversations, we had multiple dinners, and it just felt right. And we had the mindset of, we're going in, we'll do this one project, and if it's successful, that's great. We might be able to do more projects, but that wasn't something that we put pressure on the partnership that needs to be an extended relationship. We just wanted to go in and do one deal, and if it worked, we'd continue, and if it didn't, we'd go our separate ways. And luckily, it was a very successful project, and we've done 11 projects together since, and I think we'll continue to do projects in the foreseeable future.
That's great. Now, when you first met, were you all had full-time jobs at that time, and you were doing this in addition to your regular work, or did you capitalize and create an actual business?
At the time, I was working at an energy company, and I kept that job for another 2 or 3 years. One of my partners, he's the owner of a Chick-fil-A, and he still has that job. And then the other partner, he has a development company, so he still has that job, and that's what he focuses on, is just the development aspect of it. But I guess at the end of 2017 or started 2018, I left my job at the energy company, and I've been doing this full time ever since, and mainly focusing on the acquisitions and asset management of all of our existing assets and new assets.
And that's sort of the next, I guess, part of my question is, when you're looking for a partner, you're looking for people also with certain skill sets that you might not have, right? So how did that divide amongst the three of you in terms of the skill sets?
Well, I have that partnership, and I actually have another partnership that I work with now, and we do divide the duties or responsibilities up kind of based on everybody's what they're great at and their skill set. Like with one of the partnerships, the developer, he focuses just on that, and he focuses on the construction aspect. He focuses on possibly getting new land to help us build. My partner who owns the Chick-fil-A, he's also a CPA, and he works primarily with the CPA and the tax accountants. He's great with relationship building, so he helps raise a lot of the equity And then I'm more on the operations, and I also help raise equity for all of our projects, but I focus on acquiring the deals, underwriting the deals, working with all the different vendors, the attorneys, the banks, working with our third-party property managers on a daily basis just to make sure our properties are running smoothly. And I'm more the boots on the ground type person, and then they have their silos that they work in.
Sure. That's great. I can see where, the fit is there. That's an excellent mix. And with 749 units, I would imagine too that you at least had to consider whether or not property management might be another facet of what you do. Is that something you have looked at in terms of forming your own maybe property management division or something?
It's funny you say that, and we actually went down that rabbit hole last year, and I had pretty much built out a property management company, but we decided not to move forward with it for a couple of reasons. All of our assets are kind of spaced out throughout Texas and a couple other states, and from just a geographical perspective, after we built it out, I don't know if it really made the most sense for us to manage it. And then another reason we haven't, and we still might in the future, but the more people I talked to, the more people said that you really need 1,500 or 2,000 units to make it a profitable company. And it seemed like it was going to be a loss leader. I think we could have done a great job, and maybe it would have increased the NOI, which in turn would have increased the value of our properties. But I think we would have been losing money. And I'm already pulled pretty thin and worked quite a few hours, and I would have been the main person handling the property management company. And I think from maybe my sanity perspective, and then also just from an income perspective, it makes more sense if we can acquire one more asset a year. We'll probably make more money than we would have with the entire property management company for the entire year. And also, it's having a property management company. If you do a great job, that's fantastic. But I talked to a few people and that had created property management companies, and they said it's hard to fire yourself. And if you aren't doing a good job, your investors obviously expect you to do the right thing, but it would be very difficult to fire yourself and bring in somebody else. So we don't want to skew the lines with the investors. And at this point, the property management companies we have are doing a good job running the properties and managing them, and I just help oversee them.
Right. No, that's a decision I think a lot of folks make, especially at your size. What other staff did you bring aboard once you decided you guys were going to work together to sort of fill the gaps there?
At this point, we really only have 2 staff, and they aren't even full-time. We have 2 people that help with accounting. And then we do have an RV park, and we're self-managing that. And we have a property manager that's on site at the RV park, but those are the only staff we have. I've outsourced some of the responsibilities of virtual assistants, but I've never had any full-time staff helping me underwrite deals or doing the admin or marketing or anything along those lines.
And you mentioned you're on the acquisition side. That's your focus, is to find the deals?
Yes, that's one of my focus areas.
Yeah. And how is that going in today's marketplace?
It depends, honestly, which markets you're in. I mean, overall, as you know, it's a very competitive process, and cap rates are more compressed than it's ever been. So pricing's higher than anybody's expected. And since really I felt like there was a shift probably last September where people were getting through COVID and they saw where maybe multifamily didn't have a dramatic impact, or COVID didn't impact multifamily significantly. So pricing since September has just been on fire, and it is hard to get deals, and the deals in the larger markets that we're looking at usually has anywhere between 30 to 50 property tours. I've had offers on deals where we're in the best and final, then I find out there's 20 other groups in the best and final, so it's not really a true best and final, but we were able to get one deal at the end of last year, and it was quote unquote off market, but we were luckily one of only 4 groups they showed it to, just from the relationship we had with the broker. And then we're under contract on a deal in Florida right now, and we were able to preempt the marketing process. So the broker took it out and they were going to market it, but we were luckily in Florida the week it came out. We toured it, we loved the asset, and we asked the broker if we could preempt it, and the seller agreed to it. So I think at this point, really, if you don't want to go through the entire marketing process, you have to have a good enough relationship with the broker to either preempt it or somehow get I don't know if you're going to get an off-market deal, especially on 50 or 100 unit plus deal, but just have a good enough relationship to maybe be able to get around and beat the other investors and syndicators. Because if you go through that marketing process, apartments are getting bid up, at least what I've seen, usually 1 to 3 million over whisper price.
Wow. That's crazy. Man, I mean, even in San Francisco and Northern California, single family homes people are bidding $1 million over asking. Single family homes. I mean, this is like an insane market right now, but multifamily is a little bit more sane, I think. In your bio, you mentioned 250 units in the pipeline to be developed. Are you talking ground up? And if so, yeah, could you explain what's going on there?
Yes. It'll be 250 more ground up units. Part of it will be, we're doing a ground up development now that will have a second phase. We're about to open the first phase. It should have been this month, but with all the rain we've had, it's been pushed back. And we think we're going to be opening mid next month or early July. And it'll be 133 units. And then we're going to add a phase 2, which will be roughly another 120 to 130 units. And then we have land in a smaller Texas town that has a university, and we'll be developing roughly 120 student housing units there as well.
Now, these syndication deals too, I assume?
Yes, they'd be syndications.
Now, how are you dealing with these crazy, cost of building materials right now? Especially when you price out a deal and put your pro forma together, it's just, I mean, that's got to be impacting you, I imagine, on those development deals.
Yeah, that's been by far the hardest thing on figuring out the new development deals, because and before the lumber pricing crisis or shortage, I mean, we've been able to develop apartments for really cheap. Granted, we're building Class A properties kind of outside of your major markets, so we'll be 30 to 60 miles, say, west of Fort Worth, and we can build a brand new apartment for 110 to 115 a unit there. And now with the lumber shortage and with pricing skyrocketing on concrete and lumber and all the other materials, we've been projecting roughly, and this is with soft cost and everything, about 130 to 136,000 per unit. So it has went up significantly, but also land's a factor in it. Land's gotten more expensive over the last couple of years, and it's just going to keep getting more expensive. So pricing keeps going up, but at the same time, pricing on acquisitions are going up as well. So, I mean, in Dallas now, a 1970s asset, 80s asset, depending on where you are, if you're in a good part of a suburb of Dallas, you're probably paying 160 a door, 180 a door, depending. So, and the secondary and tertiary markets, we're still being able to build cheaper than what you can buy a 30 to 40-year-old product.
That's great. That's great. You've been doing this for a while now, and you've come through the recession, the Great Recession, and really, I'm sure experienced a lot of dynamics. Plus, you live in one of the most booming areas of the country, the Dallas-Fort Worth area. What did you say was probably the biggest lesson you learned from maybe a mistake that you made early on that do you think might be something valuable to share with our audience?
I guess I'll share two lessons I learned, because the first one, it didn't really have, well, I can't correlate it to productivity or anything, but early on, I was way too conservative, and I never thought I had analysis paralysis, but I underwrote deals and used rule of thumbs that from an expense ratio and maybe an income perspective that just weren't realistic. And especially in today's market, if people underwrite as conservatively as I was at that time, I would have never got a deal. So I think you do need to, if you keep striking out, maybe talk to somebody that has done it before, or get a mentor, or just be able to go through some of those pain points to accelerate your path faster. But a more tangible failure I had was one of the properties we bought. We had a third-party property manager on another asset we have, and they were doing a great job. So we were like, okay, we'll put them at this new property. And the on-site manager I knew from day one she wasn't going to cut it. And I should have spoke up immediately, but I didn't. And then we had 3 deployments. It's in a military town, and our occupancy went from like 90 to 65, 70% over about a 3-month time frame.
Oh, gee.
And I just trusted the manager, and I listened, the company, and I just listened to them, and I thought that was kind of average. And for that deployment, I knew it was a big deployment. It was one of the biggest that the military base had done. And after 3 months, nothing had changed. So I called a couple of owners and operators in that market, and they were like, we were at 80%. It was bad, but we never dropped down to 70. So I immediately fired them. And I think looking back on it, I would have went with my gut that I should have made the switch sooner, instead of waiting a few months to hopefully give them the benefit of the doubt, turn it around, just acting more swiftly for our investors and myself.
Great. What about successes in terms of something that you did that really worked out well, and that maybe even affected the way you do things now?
Well, before we jumped on the call, we were talking a little bit about just one thing I pride myself on is strategic thinking and trying to think outside the box, unlike a lot of operators. And one thing I did on this last acquisition in Atlanta is my background in consulting and property tax played a key role in it. Is Atlanta is a disclosure state, and they value real property on 1/1. So we were going to be buying an asset, and it was going to close at the end of December of last year. Well, I knew if we closed before the end of December, the county would know what our purchase price was on the property, and the purchase price was more than double what the appraised value was on the tax roll. So our property taxes for this year, for 2021, would have increased potentially up to $115,000, but I think conservatively about $80,000. So we closed a few days after January 1st, and it saved us about anywhere from 80 to 115,000 in cash flow this year. So I pride myself in looking at just kind of outside the box things and not always the cookie cutter. I guess just being cookie cutter and having a black and white path to each acquisition. Every acquisition is a little bit different, and you need to look at it on an individual basis.
It's great. Great tip there for people too. That's great.
Yeah.
Our group is that's listens, at least our targeted group. We have a real wide spectrum of people that listen, but, we're really targeting those that are 50 years of age and older. These are folks that are approaching retirement, already in retirement, and they're looking at real estate investing as a means to, either generate additional cash flow and income for them in their retirement, or maybe it's a way to sort of leverage that nest egg that they've got for the rest of their life to be able to generate the kind of income that they wouldn't have to draw upon the principal so much in. What would your advice be for folks that are in that position as they're looking at real estate? And you've experienced it from buying single family homes, up through large apartment complexes and ground up construction, all kinds of things. So, what would you recommend for that group that would be something that could help them to obtain their goals?
Yeah, I think that's a great question. And not everybody has the same financial plan. So it's hard to construct, I guess, an ideal answer. But I do think each individual needs to look at what their goals and dreams are, I guess, for their retirement. And even within real estate, you have so many different types of real estate you can invest in. And in multifamily, you have the value add, you have the yield play that's stabilized, that gives a cash flow from day one. You have developments that you might not receive any cash flow for 2 or 3 years, but you'll have a large pop on the back end. And then you can diversify geographically or by diversifying with different sponsors. So there's a lot of ways an individual could invest. It just kind of meets whatever meets their goals. I think it's important to align. Even the whole period of investment, like some people need their money back in 3 years. Well, you probably shouldn't invest with a sponsor that wants to hold the deal for 5 to 7 years. So there's a lot of things to think about when you are selecting the real estate investment of your choice, because they aren't all equal and they all have pros and cons to each investment, depending on when you need your money and what type of return you're expecting.
It's great. Great advice. Well, you've got some great things going on there. I mean, you're CEO of Bates Capital, you're co-founder of Trinity Capital. What do you see ahead for your company or companies here? And where do you want to see your company go in the long term?
I'm still a relatively young guy, and I've luckily found my passion, and I love real estate. And I tell friends and acquaintances that I could do this till the day I die. And I love going into a city and making an impact, not only on the city and the asset we either buy or develop, but also improving the lives of the tenants and also helping the investors reach their goals and hopefully leaving a legacy for their family and their kids. And I just love the responsibility that brings. And I don't know, I've never really had a set goal of how many units I want to own by a certain date or anything like that. But I just want to continue growing my portfolio with assets that I believe in, and that I invest in all the assets that we buy. And I just want to be able to create a good return for everybody involved.
That's great. That's great. Well, we're kind of zipping along here, and a lot of questions I have, but I'm going to have to respect your time here as well. We have what is called our Wrap It Up session that I ask you a series of quick questions, kind of like a lightning round. And where you can share resources that have been valuable to you and our listeners might not even know about. So that'd be helpful if you could do that. Are you up for wrapping it up here?
Yeah, definitely. That sounds great.
All right. Favorite real estate book?
I guess I'll have to go with Rich Dad Poor Dad. That was, I know it's a common one, but I think that was the book that changed my mindset on, or it explained how beneficial real estate is, and just changed my mindset from an employee to an investor perspective.
Same here. That's still my top of my list. How about just a favorite general business book?
I read this a long time ago, and it's Darren Hardy's The Compound Effect. And I was on his daily emails, and I think he just provides a lot of great knowledge that you can apply not only to business, but your personal life. And it's the compound effect's mainly about just creating doing this same repetitive task day over day that creates a large snowball effect.
Great. I have to check that out. How about a website that you use that is just invaluable to you in your business dealings day to day?
There's quite a few, but I think one of the ones I use is, niche.com or censusreporter.com. I look at those two when I start any deep dive into acquisition, just because it gives you so much data on the area, and I get a lot better idea of the area than maybe I had before.
That's great. I haven't heard of niche.com. That's like one I got to check out here. That's great. How about a favorite app? Anything on your phone that you use that's valuable to you?
I'm an avid, I say reader, but mainly listener to books. So Audible, I love that app. I've had it for a few years, and I use it pretty much every day.
Yeah, I love that one too. A favorite. How about a favorite quote?
I saw this a long time ago, and it was by Henry David Thoreau. Go confidently in the direction of your dreams and live the life that you've imagined. And it just has always resonated with me. And I think we're built to achieve greatness and achieve great things, but we have to have the dreams and goals to get there.
That's great. That's great. I like that. And our final question, if you lost absolutely everything, all your assets, and you had to start over, knowing what you already know, and you only have $1,000 in cash, what would you do to launch your real estate investing business?
That's a really good question. I've been a big proponent on partnerships, and I think, like they say, your net worth is your network. And I would probably just start going and trying to talk to people I'd known previously, and see how I could add value to them and bring them possibly business. And I think it'd reciprocate, and in turn, I'd be able to launch the real estate business that way.
That's a great one. Wow. You got that one. That's another quote we probably should throw in there.
Yeah, exactly.
Great. Now, did you have, any groups that you joined initially, or did you just kind of, pick out, as key people you wanted to make contact with?
Back in 2009, I did join a group called Lifestyles Unlimited. They're based out of Houston, but then they have offices in Dallas and San Antonio, Austin area, and I think now nationwide. And I was involved with them for a couple of years. And then when I got into the single family business, I didn't think I really needed their assistance anymore. So I haven't joined a group since then, but there are a lot of groups that are good for people, especially people just getting into the business. And now with podcasts such as yours and social media, there's so much information out there, but having a group also can be a catalyst to get you into the investing career, or just provide you a lot more information than you might be able to find through social media.
That's great. That's great. Well, I'm sure there's a lot of folks listening that would like to find out more about you and your company. What's the best way for folks to do that?
Yeah, they can go to batescapitalgroup.com, and it has information about me, and you can sign up for a newsletter or schedule a call with me if you'd like to know more. And I'd be happy to discuss real estate. I love talking about real estate with whoever and whenever.
Oh, that's great. That's very generous of you. Wow. Well, gosh, Sam, this has been fantastic. A lot of good information, and I think some tips in there too that we don't even have to pay for, which is great. So, but we have a tradition here on this show that you probably already know about, but we, and you're from, Texas, man. There's all kinds of hound dogs all over the place out there. So if you would like to, I would love to have you close us out with your best old hound dog howl.
I'll do my best. I can't promise if it's a great hound dog howl, but ooh.
All right. You got cut off there, but that's awesome. That was great. Great. Well, Sam, this has been really a blast, and thank you very much for coming on. I really appreciate it.
Well, thank you, Bill. I loved being on your show, and hopefully I provided a lot of valuable information to your listeners.
Definitely. And I also want to thank all our old dog listeners out there for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything that Sam talked about today will be outlined in detail in our website, show notes on the Old Dogs website at olddogsreinetwork.com/blog. And you're going to look for the episode with Sam Bates. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.